Today, the persistence of inflation. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, as discussed yesterday, the US inflation read was seen by the markets as important. A fall in the number would lead the markets to potentially regain their footing. And before the report, economists had been betting that annual inflation would dip below 7% in the third quarter of this year on expectations that supply chains will get back in order and inflation will dent demand. And of course, Joe Biden had come out before the number was released saying, "I want every American to know that I am taking inflation very seriously and it's my top domestic priority. The first cause of inflation is a once-in-a-century pandemic. Not only did it shut down our global economy, it threw supply chains and demand completely out of whack. And this year, we have a second cause, Mr. Putin's war in Ukraine." And Biden went on to propose solutions like lowering everyday costs for hardworking Americans through Medicare price negotiations and caps, improving operations at ports to reduce supply chain logjams, and promoting competition to get smaller companies into the market. And lowering the deficit will also be a priority by asking large corporations and the wealthiest Americans to not engage in price gouging and pay their fair share in taxes. And with regards to cutting high energy prices, Biden said he had led the world in the largest release of oil from our stockpiles in history, allowing biofuels in gasoline, and is driving green investment at the same time as near-record domestic crude production. Oil companies will also not get a free pass for unused oil leases, numbering around 9,000 nationwide, and will be required to pay taxes on them if they don't produce more oil. And Biden said he agrees with the Fed Chair Jerome Powell's assessment that inflation is the number one threat to the economy, adding, "I'm confident the Fed will do its job with that in mind." Now, let's just not mention the ultra-low Fed-induced interest rates and the quantitative easing programs that stoked liquidity and asset prices. Actually, the Fed and other central banks created the monsters, but of course, they've got some nice excuses now: supply chain disruptions, COVID, and the war. Anyway, Americans got little respite from inflation in April as prices for a range of necessities and discretionary spending categories continue to climb at some of the fastest ever rates. The Labour Department said on Wednesday that its consumer price index slowed to 0.3% last month from 1.2% previously. That exceeded forecasts for a slowdown of 0.2%. Consumer prices in April year-on-year slowed to 8.3% from 8.5%. Grocery prices were up 10.8% over April 2021, with meat rising 13.9% and eggs up 22.6%, in part due to an outbreak of avian flu. While annual measures of consumer prices cooled slightly from March, signalling perhaps a peak that economists expected, the details of the report painted a more troubling picture, as monthly figures advanced more than forecast. Services costs accelerated and inflation for most goods remained stubbornly high, underscoring the persistence and breadth of price pressures. There's little relief in sight as Russia's invasion of Ukraine, combined with COVID lockdowns in China, further disrupts supply chains and pushes up prices for everyday essentials. That's only going to make the task of taming inflation without tipping the economy into recession more challenging for the Federal Reserve, and it increases the heat on President Joe Biden ahead for the midterm elections. Whatever minuscule chance there was that inflation was already beginning to calm down has been dashed, Stephen Stanley, chief economist at Amherst Pierpoint Securities, said in the note, pointing out that he doesn't see prices cooling. Economists had been betting that a moderation in goods prices would help inflation come down as Americans emerge from pandemic restrictions and shift their spending to services like dining out, but that's not happening yet. Services inflation was strong across the board, keeping core inflation elevated even as the pandemic-related excess in the goods sector has begun to subside. That underscores how the Fed's delay in raising rates has helped make inflation more sticky. The annual gain in food costs was the biggest since 1981 and included record advances in prices of chicken, fresh seafood, baby food, and prepared salads. Meantime, the cost of fats and oils used for cooking rose the most since 2008. In terms of services, costs for home utilities such as electricity rose 13.7% in April from a year ago. That's the most since 2008, and airfares surged a record 18.6% on a monthly basis. Shelter costs, which include rents and hotel stays, also rose 0.5% for the third month, which has been the highest since 2005. Those price dynamics will likely encourage the Fed to continue tightening policy at an aggressive pace. Officials last week raised interest rates by the most since 2000, and they've signalled more half-point hikes are on the table in the coming months. The Fed has little option but to keep jacking up interest rates to at least neutral levels as fast as possible, Sal Guttari, senior economist at BMO Capital Markets, said in a note. The measure of so-called core prices, which excludes food and energy, rose 0.6% in April from the prior month, exceeding all estimates. The increase in the headline monthly figure was also more than forecast, although it was restrained by cheaper gasoline prices that have since climbed to a record. Inflation accelerated 8.3% from a year ago, a slowdown from the prior month, but still among the fastest in decades, and wages aren't keeping up. When adjusted for price increases, they fell for the 13th straight month in April, contributing to Biden's dismal ratings among voters. And some aren't as optimistic. Wells Fargo and co-economists on a Wednesday that they expect inflation to get stuck at a little under 8% year over year in the period. More than 60% of categories have seen price rises more than 5% over the past year, which Wells Fargo noted was a slight improvement from March, but still the worst in decades. Inflation remains widespread, making it the more difficult to curtail, economists Sarah House and Michael Pugliese said in the note. Powell said last week that the Fed wasn't seriously considering a 75 basis point increase in the next two meetings, but after today's CPI report, it may warrant some consideration, Jeffries said in the note. The Fed is walking this fine line between pushing the economy into recession and pushing down inflation, Melissa Brown, Managing Director of Applied Research at Quantago, an index and analytics provider, said in an interview, I think that line has gotten finer. So as a result, the Dow Jones plunged to fresh lows for the year on Wednesday, as an ugly reversal in tech fueled a broader sell-off. The Dow Jones Industrial Average slipped 1.1% to 31,834. The S&P 500 fell 1.62% to 3,935, and the Nasdaq fell 3.18% to 11,364. Against the backdrop of growing bets on a more aggressive Fed, big tech gave up the gains and resumed their sell-off. Apple fell 5% to 146.50, a move that saw the tech giant relinquish its crown as the most valuable company. Rising energy stocks, however, attempted to limit downside momentum in the broader market, underpinned by gains in the Occidental and a jump in oil prices on fresh supply fears. Ukraine suspended gas flows to Europe via a major transit point located in the Donbass region, blaming Russian interference. Occidental Petroleum gained more than 1% after reporting better-than-expected quarterly results as rising energy prices bolstered growth, and Coinbase Global, meanwhile, reported first-quarter revenue that fell short of expectations as the rout in cryptocurrencies, including Bitcoin, and lower market volatility weighed on growth. Its shares fell more than 26%. Now, there are some on Wall Street who believe that the long-term investment case for Coinbase is intact, even as the cryptocurrency trading platform flagged slower growth in the coming quarters. Oppenheimer cut its price target on the stock to $197 from $314, but pointed to positive fundamentals, including ongoing crypto adoption and the company's strong balance sheet that ensured the long-term investment case on Coinbase remains intact. Gold was around 852, little changed, while WT oil rose to 105.86. The volatility index eased slightly, but still at an elevated 32.56. And the dollar index was up again to 104. The US 10-year bond rose a little to 2.925, while the 2-year was up 0.7% to 2.6474. And Bitcoin fell significantly. In fact, at one point it fell 7.23% to 28,758. And that's a loss of more than $2,241 from the previous close. It rose a little towards the end at 29,040. Bitcoin, the world's biggest and best-known cryptocurrency, is now down more than 40% from the year's high, 48,234 on March the 28th. And Ether, the coin linked to the Ethereum blockchain network, dropped 11.56% to $2,071 on Wednesday, losing more than $270 from its previous close, before rising a little to $2,094. And locally, the Australian market is set to be weak again, while the Aussie is at 69.38 on the back of the stronger US dollar. So, in short, and standing back a little, the April CPI reading was not what the Fed was hoping to see, and the narrative around a larger move could really start to shift, especially if May's inflation report also comes in hot. That data is going to be released on June the 10th, ahead of the FOMC meeting on June the 14th and 15th. This should put talks of 75 basis points back on investors' minds, as well as on the FOMC table, Roberto Paoli, head of global policy research at Piper Sandler, said in the note. It's too soon to tell what the Fed will do in June because there is another CPI report due a couple of days before the meeting, but there is now upside risk relative to the 50 basis points that seemed a foregone conclusion. Other Fed watchers argued that the central bank is likely to stick to the plan it laid out for the next few meetings. It's a high bar to shift away from guidance, but today's outcome most certainly was not what the Fed assumed, said Karim Basta, chief economist at 3 Capital Management. Powell's comments leave the door open to alter the outcome, and the next inflation report will be highly important, he wrote. Cleveland Fed President Loretta Mester on Tuesday said she supported raising rates by 0.5 point at the next couple of meetings and then speeding up or slowing down the pace of increases based on what happens with inflation. We don't rule out 75 forever, right? The cadence we're going to see now is about right to me, Mester said during an interview. We're going to have to assess whether inflation is actually moving down, and then we'll be able to get more information after we do a couple of those to see, she says, referring to a 50 basis point hike. Policymakers could raise rates more modestly by 25 basis points in September if future reports show that inflation is beginning to weaken, said a senior US economist at UBS Investment Bank. We think the inflation outlook is going to look very different in September than the current situation, though the risk of a 0.5 point move that month would increase if inflation remains strong. But of course, this is now getting very political. For Biden, turning public opinion on inflation before November's midterm elections is crucial if Democrats have any hope of maintaining their congressional majorities. Just 36% of Americans approve of his handling of the economy, and 87% say they're concerned by inflation, according to a recent poll. But while 2/3 of Americans blame Putin for rising prices on crucial products like gasoline, 70% point to the policies of the Biden administration. So the White House seeks to address the growing cost of groceries with new initiatives aimed at encouraging more planting and harvesting of food. Food inflation has been exacerbated by Russia's invasion of Ukraine, which has disrupted one of the world's great bread baskets, an especially important source of wheat and other grains and cooking oil. One new measure will expand the eligibility for crop insurance for farmers who plant twice on the same land in the same year. My administration is looking at how to extend crop insurance coverage to give financial security to farmers, Biden said. And the administration will also make it easier for farmers to collect cost-sharing subsidies for so-called precision agriculture, in which technology is used to refine the use of irrigation, pesticides and fertilizers, and the government will double to $500 million federal spending on domestic fertilizer production, a sector experiencing supply chain logjams. But the farm visit also was political in tone, with Biden seeking to combat criticism over rising inflation under his watch by shifting the focus to Republican lawmakers, whom he accused of supporting policies that benefited companies he says are responsible for high prices. Putin's war against Ukraine is not just against the Ukrainian people, it's against the world's most vulnerable people, Representative Jim McGovern, a Massachusetts Democrat, said after meeting with Biden at the White House on Tuesday. He's blocking the shipment of food from Ukraine, wheat, sunflower oil, maize, to get to Africa and get to the Middle East, and it's going to result in a hunger crisis much worse than anybody anticipated. Now, of course, consumers in the US are less directly affected by the rising costs of grain and other crops than people in lower income countries, as farm commodities only account for about 16 cents per dollar of US grocery store retail prices, according to US Department of Agricultural data. In fact, labour, transportation and marketing costs are the biggest factors in US food prices. But Americans have been particularly hard hit by surges in retail costs for beef and other meat, triggering Democratic allegations of profiteering against the giant packing companies that dominate meat processing in the US. 4 companies slaughtered 85% of grain-fattened cattle in 2018, according to the USDA. Only 4 big companies, by the way, control more than half the markets for beef, pork and poultry, Biden said. Without meaningful competition, our farmers and ranchers have to pay whatever the 4 big retailers say. And meatpacking executives attribute the price increases to difficulty recruiting workers for slaughterhouses and high transportation and feed costs for cattle and other livestock. Tyson Foods, the largest US meat company by sales, disclosed this week that it has been subpoenaed in an inquiry of its pricing practices from the Office of New York Attorney General Letitia James. And Federal Reserve officials face pressure for more aggressive action after a hotter than expected inflation reading in April, although so far officials are sticking with their strategy to keep rising interest rates by half a point at each of the next 2 meetings. We've got a plan in place, which is 50 basis points at the last meeting, and teeing that up for future meetings as well, St. Louis President James Bullard said during an interview with Yahoo on Wednesday. I think that's a good benchmark for now. And asked if a 75 basis point move might be necessary, Bullard said it was not his base case. He said the inflation report showed that price pressures were broader and more persistent than many had thought. And his Atlanta colleague Raphael Bostic told a separate event in Jacksonville, Florida, that he would be supporting moving more if inflation continued at the current high price. And so at nearly the halfway mark in a volatile year of trading, the S&P 500 index is down but not out to the point of an official bear market yet. According to a widely followed definition, a bear market occurs when a market or security is down 20% or more from a recent high. And the S&P 500 has been skirting ever closer, dropping below the 4,000 level on Monday to bring it just a little above 20%. For now, the index is in correction territory, often defined as a 10% drop from a recent high. And the battered Nasdaq Composite, meanwhile, is down 27% from November 2021, so that is a bear, and a big bear at that. The S&P bear market debate is raging at the moment, with some strategists and observers saying the S&P 500 is growling just like one should. Wall Street banks like Morgan Stanley have been saying the market is getting close to that point. But should the S&P 500 officially enter the bear's lair, Bank of America strategists led by Michael Hartnett have calculated just how long the pain could last. Looking at a history of 19 bear markets over the past 140 years, they found the average price decline was 37.3%, and the average duration about 289 days. And while past performance is no guide for future performance, Harnett and the team said the current bear market would end around October this year, with the S&P 500 at around 3,000 and the Nasdaq Composite at 10,000. Well, who knows about that? But it does signal further uncertainty, further volatility, and probably more falls ahead. But let's face it, the inflation genie is out of the bottle, and nobody really wants to admit the underlying cause, which was the years and years of quantitative easing and ultra-low interest rates from central banks. The other excuses, of course, are much more convenient. The war in Ukraine, the COVID-19, and the supply chain disruptions. They are very convenient alibis, but actually central banks, you are to blame. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.